why, if this is such a great opportunity, and why these are such fantastic businesses, these general partnerships, private equity firms, why in the world would the owners of these fantastic firms want to sell a piece of the golden goose? Golden goose, the goose that lays the golden eggs? Well, there's a couple of reasons. Apologies for the small font here, but I think it's helpful to talk about these things in sequence. Really, if you think about it, these private equity firms started off fairly small with smaller funds. They could write the checks themselves for the co-investment, or maybe they had some rich uncle that was writing the checks because they're putting in 5% of a $100 million fund. That's $5 million. And then maybe they raised a $200 million fund, $10 million co-investment check. As they got bigger, maybe they reduced that percentage from 5% down to 2-3% co-investment. But now we're talking about $5 billion funds, right? So they're having to write a $100 million check if they're only doing 2%. Obviously, it gets higher from there because once they put that money to work in year 3, they're already raising a new one, and perhaps they have multiple product types. So they're always raising a giant fund every other year. So they're constantly writing checks. Yes, sometimes those funds are coming back and they're getting some profits and carry. But the bigger they get and the more successful they are, it's harder and harder for them to come up with that capital. And this is especially true if they're having their associates and their VPs and their younger personnel write checks to contribute to that co-investment. Because everybody likes to see skin in the game. And even the general partnerships, they want to see their personnel, their staff, writing checks to contribute to these private equity funds. So they know that they're committed and they're going to stay through the life cycle of the fund, get their percentage of the carry. They can keep their talent and know that their staff is committed to the company and this future success of the firm for 10, 15 plus years, which is a great way to keep people invested and keep the culture the same, which is what you want to see from a general partnership. So the number one thing is being a victim of their own success with the GP commitments getting larger and larger. Number 2, new products. As you can probably see, the biggest firms have added new investment prototypes as they've gotten bigger because they realize that, okay, we're pretty good at real estate. We're pretty good at private equity. While private credit is similar to private equity, we're still going on talking to the same type of companies. This is just a different part of the capital stack. And so oftentimes you'll see the Blackstones of the world, they'll add a debt product. And so they're expanding into a new product type. And sometimes that means you're going to go out and hire a brand new team, or you're going to buy a new company, a private equity firm, and bring that in-house, the buy versus build strategy. And that costs money. And if they're not a public company, they can't just issue new shares for that capital to go buy those other companies. They have to actually go raise the capital to do that or pass the hat around, which once again, we're getting to the problem of writing bigger and bigger checks. For people that don't have an unlimited amount of money, they're writing giant checks for these firms. All right, number 3, expansion. If they're looking to expand to new international markets, same kind of problem as expanding into new product types. They might have to buy a team, they might have to buy a company. Perhaps they want to buy a technology company or operating service business that's going to help all of their companies and improve returns overall. So, which doesn't happen as much, but it can happen. Number 3, which is actually not listed in this category, which is our fault, but it's the most important, is meeting new limited partners, expanding their customer base of institutional partners that are going to give them 20, 50 million, $100 million checks to grow their assets under management, which of course, as minority stake investors, we also benefit from management fees, additional promote. Right? The bigger they get, the higher the enterprise value is at the firm. Also, we benefit from that. And so the middle market firms especially benefit from this, right? The mega private equity firms already have all these relationships for the most part, but the middle market, smaller private equity firms that kind of round up the portfolio usually, they definitely could use introductions to limited partners that the GP stakes investor already has. Right? The GP stakes investor is invested across a ton of different private equity firms and also has its own limited partners that invest in the fund. So this becomes strategic capital for the middle market private equity firm that is looking to grow its AUM through those introductions, those warm leads, so they can grow their AUM faster than the small dilution they took by giving up its 10-20% equity stake in their firm. So it's a win-win. Everybody's share of the pie grows because they have more assets to invest, which happens all the time in the middle market range private equity firms that that don't already have all the existing LP relationships internationally, sovereign wealth funds, you name it, right? It's a big universe of limited partners. And unless you're Blackstone, you probably haven't met everybody. Anyways, that's three, that's expansion. That's a very critical aspect of why why private equity firms will actually do this. And then four is equally as important. As you can imagine, you have people that might want to retire out of the firm someday, and it's not a publicly traded company. They can't just sell their shares once again in the stock market and get out next day. Those partners need an efficient way to sell their shares to the other partners in the firm. And that needs to happen without every partner having to go get a giant loan, sell their house, take on a bunch of new debt, which stresses the culture of the firm, which stresses the individuals. They would much rather have an efficient way to have those shares valued and then executed. And so they can actually plan thoughtfully about succession as opposed to just reacting to a surprise, oh, I need to leave. And this also enables the younger partners of the firm to see a very clear path to getting more ownership in the private equity firm, which once again improves culture and extends the duration of their career with that private equity firm. All right, so those are four reasons why a private equity firm, a very successful private equity firm, would still sell 10 to 20% of the goose that laid the golden eggs, got it right that time. Even though they have such a wonderful business model, it still makes sense for them selfishly to sell a piece of their firm in order to accomplish these goals, which they could do if they went public. They could accomplish all these things, but that brings a whole other hornet's nest of issues being a publicly traded company, which is very expensive, very stressful. A lot of these guys don't want to do quarterly earning calls. A lot of them don't want to have to upgrade and spend the money on all that crazy reporting. It's a big burden to go public. So if they want to stay private and still grow, they have to do things like this. All right, hopefully that was helpful. If you want additional info on GP stakes investing, visit evergreencap.com.